Here's what's coming up on The Retirement Architect with David Reyes, your retirement television.
The worst place to be is bond market. Bonds are what I call today return-free risk. Because basically, if you're getting a bond that's paying you 2%, inflation's running 8%, you have a negative 6% rate of return, right? And basically no growth. So bonds you have to be careful with right now. Most of my clients are in their early 60s, mid 60s, they're about to retire, retired. The difference is if we start taking income during these markets, it's going to be a problem. That's how you run out of money. Years ago, it was called the 4% rule. I mean, you could take out 4% of your money on $1 million, $40,000, and now that's about 1.8%. I mean, I can tell you, doing this for a long time, we can't live on 1.8% of our retirement proceeds for most people.
The best strategy in retirement is buy and hold. True or false?
That would be false. That'd be false. Yeah, false. Because when you're accumulating assets, fine. Mark goes up, mark goes down. But when you go to retire, the fact is we want to make sure we protect capital. A lot of times you just can't wait for that buy and hold and that dip to be 20, 30, 40, 50%. So no, we want to protect capital at all times.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Hi, San Diego, and welcome to this week's show.
Stay tuned. We have 30 minutes of great information just for you.
Don't go anywhere. The show starts right now. Hi, and welcome to this week's Ask the Architect, where you email your questions into us and we answer them right here on the show. David, I have some great questions this week. My first one is from Derek in Carmel Valley, and he writes, "Hi, David. A dear family member has just passed away and has left us a considerable amount of money. The amount is well over $1 million. We are very concerned about how much in taxes we will have to pay. What can we do to reduce the amount of taxes on this?"
Well, Derek, first of all, very sorry for your loss. And I deal with these kind of questions a lot with people passing away, with family members. And the tax part of it can be complex. You have estate tax issues, income tax issues for yourself. And unlike retirement accounts, the growth of those assets can be taxable too. So that's really kind of a 3 or 4 part tax question. So really the best thing I would advise you to do is seek some tax advice, both from the estate planning side and also from an income tax side. So that's a big question.
And really a relevant question too, because I just wonder, and this is kind of a side note, first of all, always sorry to hear when a dear loved one passes away, but what can be done ahead of time, David? I know I'm kind of doing a curveball right now, but there are a lot of things that can be done ahead of time, and I think it's important to note because we're all going to leave the good earth, right? And as a friend of mine likes to say, there's not a U-Haul behind us with all our stuff. So we really need to make sure that all of these pieces are put together in such a manner so that they pass smoothly, right, to our heirs and beneficiaries in a perfect world with less taxes. Do you do stuff like that?
Absolutely, yeah. We have our own in-house estate plan attorneys. We work with CPAs in our building, and so yeah, that's you just having a basic trust to start with. And believe it or not, a lot of people don't have. I've had 2 attorneys pass away in the last 2 years that both didn't have trusts.
Oh my goodness. And they were attorneys.
Attorneys, yeah.
And so we look at the general public and we say, because you see people all the time, hey, listen, and this is another follow-up to this, there are some pieces that everyone should have in place for the legacy planning part. Yep. Maybe just take a minute, tell me about some of those pieces.
Yeah, for sure is a trust, a living trust. There may be insurance that's maybe needed to pay estate taxes if you have a really large estate. For sure, having a plan of knowing what type of income is going to be produced from assets that are left over. Because if you have to pay taxes, certain assets are tax friendly in estate planning, some are not. Annuities happen to have some negative connotations relative to taxes, relative to IRAs can too. IRAs have to be fully distributed over 10 years, which means a bunch of taxes. So it's a really complex question that most clients have no idea what that's going to look like. So it's an important topic. So I would say knowing, having a trust as number one, and number two, having some type of plan, knowing after what the taxes are going to be and what the assets are going to be left over, so that the income that can be produced is known.
Great. Thank you, David. My next question is actually from David. He writes, David, our advisor years ago set up our portfolio with about half bonds, the other half being in the market. We are all set to pull out 4% per year. We're worried that this strategy, along with my wife's pension and our Social Security, may leave us short in our retirement. Are you familiar with this strategy, and is it a good one?
Yeah, David, thanks for the question, and that's very appropriate right now. I mean, bonds are actually losing more than stocks this year. I mean, I was reading an article just the other day, and pension plans, they're concerned now because stocks and bonds are actually falling together, which hasn't happened in about 20 years. So that's not a good plan. I mean, the average yield, just the income from that plan, is about 1.5%. So 4% is aggressive. That's one way to run out of money, by withdrawing more money than what the market is producing. So, I would consider that not a strategy. And so the fact is that he definitely should have a second look at that and have somebody look at that for him to look at some other ways to, mitigate the risk of running out of money, because that's the problem. Running out of money is at a high level right now because of the bond market.
A couple follow-ups to that. This was a good strategy in the 80s and 90s. Is that a fair statement? I mean,
Absolutely.
Everything was going up, 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 up. You didn't have to worry about 4%. You were making more than 4% every year. And the second piece was, I believe, and I want to source it correctly, it's either Forbes or Yahoo Finance, they were talking that this 4% rule has really come down through the years, that if you're going to be in a safe level right now, it's actually sub 2%. I think it said 1.9 is if you're going to take money out of a portfolio structured like this. Familiar with that?
Yeah, I think it's Morningstar does a report on that. I think it's 1.8% right now, which makes sense. And that's not including inflation running at 8% right now. So the worst place to be is bond market. Bonds are what I call today return-free risk. Because basically, if you're getting a bond that's paying you 2%, inflation's running 8%, you have a negative 6% rate of return, right? And basically no growth. So bonds you have to be careful with right now. Fortunately, bonds have not been a big piece of our portfolios for clients for a while, really since 2008, because interest rates have been so low. And now rates are rising, so what's happening is the actual value of bonds is falling. So you have a time that we've not had in 2 decades where stocks and bonds are falling together. So that portfolio of half stock and half bond is down 10%, as of the first half of this year.
And I would be remiss not to bring up inflation.
Absolutely.
Because if inflation, well, it is at 8%. If inflation stays where it is, okay, how will that affect pre-retirees and retirees, and what can they do to protect themselves from inflation that doesn't seem like it will subside anytime soon?
Well, bonds are the worst place to be, number one. So reducing bond allocations is number one. Number two, be involved. Look at real estate's been a great asset class. Real estate historically has been one of the top performing asset class over the decades. So most people have no investment in real estate. I'm talking hard asset real estate, not real estate mutual fund. We'll have another segment on that, hopefully. That's one. Dividend paying stocks, right? Dividend paying stocks, companies have a history of increasing their dividend. Right? There's certain companies that have average, what's called dividend aristocrats that have a history of about 6% per year increases in dividends. Home Depots of the world, the Verizons of the world, certain companies. So not only can you get the growth of the stock, but also increasing income in the dividends. There's lots of ways to deal with that.
Thank you for that, David. Hey, if you want more information, great topics today on anything we spoke about here, hey, give us a call in the office or go to our website. And don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Are you unleashing the possibilities of your assets in retirement? Hi, I'm David Reyes with Reyes Financial Architecture. As a retirement and investment advisory firm here in San Diego, we've helped countless retirees and pre-retirees create a cohesive plan to maximize their assets and, most importantly, their cash flow in retirement. Call 866-REYES-PLAN right now to schedule a complimentary second opinion review. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Hi, San Diego, and welcome back to the program. I'm here with best-selling author, TV personality, and of course, your radio host, David Reyes. David, we have a great topic today that we're going to be talking about, and that's the risk inside of that sort of traditional, I'll call it antiquated, 60-40 portfolio. Why don't we start with, what is that? What is a 60-40? I'm sure a lot of people are familiar, but there'll be some who are saying, hey, I don't know what that is.
Yeah, and it's probably 50-50, right? So I got to be careful too when I talk to clients. Yeah, it just means that you have 60% stock and 40% bonds. So that could be in individual stocks and individual bonds, or bond funds and stock funds. Most people have mutual funds, so it's stock mutual funds and bond mutual funds. So, I call it the boomer portfolio. I came up with that a couple years ago because every baby boomer has some iteration of that. Most people that are working have what's called target date funds, which are kind of another form of that, which are even worse because the fact is, as you get closer to retirement, every year what it does, it sells stocks and buys more bonds. So this year, stocks have been as risky or bonds have been as risky or more risky than stocks. So how crazy is that? Yeah. Right? So you're buying more assets, number one, that are losing value right now. Number two, that have very little yield. So antiquated is probably a really good word for that.
And it's, I feel bad because savers are being punished obviously by low interest rates, but for those that are using bonds as that conservative part of their portfolio, they're also getting beat up a little bit too, right?
Yeah. I've mentioned an article a couple times that in the Wall Street Journal this last week where they were talking about pension funds. This board was trying looking for ways to increase the return. They were saying we just want to buy something that's going up because think about that. Most pension funds target return needed is 7%. Which is really outrageous. I mean, that's a high number.
That is a high number in today's marketplace.
And so what I've seen over the years, they've gone less bonds, about the same amount of stock, but they've actually added hedge funds and actually had across the board. I'm talking pension funds in general and what's called private equity, which is kind of a black box because it could be a company that goes gangbusters or goes bust. So private equity, it's kind of the next, you'll start seeing that private equity is being kind of pushed on the retail advisor now, the retail investor now, which is dangerous because it's kind of it's like who knows what's going to happen with that.
Right.
And so it's another financial product that's being pushed. I'm starting to see it now.
But is the SEC and FINRA, are they cool with that or?
Unfortunately, I'm pretty cynical about it, but it's all about the money. You know what I mean?
It's
and so it's another product that they can push out. It is. It's just the sad
gain.
It's like, okay, another product. It's like Bitcoin. How can we market something to make more money? Fidelity, in fact, just is now allowing Bitcoin inside their 401k plans. Just got announced recently, which I think is crazy. But that's my personal opinion.
Yeah. So me, I have a conservative streak. I want to keep it. I want to sleep well at night, and this actually segues me very well into the first topic that we have here is, hey, all of these things, at the end of the day, it's about not running out of money. So that traditional 60-40 can potentially leave the door open to a quick spend down.
Absolutely.
If you don't have someone that's looking at it very regularly and making sure, and now those, what did you call them? Those target date
funds.
Goodness gracious. And if that's throwing you more into bonds, the opportunity, and I'll call it a bad opportunity, to spend down your cash in retirement, the ultimate nightmare for seniors right now. How do we avoid that?
Yeah, and most people are just basically taking that fund and they're spending money out of it. Think about that. So Morningstar comes out with reports every year. We talk about, and years ago it was called the 4% rule. I mean, you could take out 4% of your money on $1 million, $40,000, and now that's about 1.8%. I mean, I can tell you, doing this for a long time, we can't live on 1.8% of our retirement proceeds for most people. Most people don't. I think less than 10% of people have pensions. Right?
Yeah, and I love to put that in perspective, and we talked about it in another show where if you have, and you've been a good saver, and you put away $1 million, 1.8 is $18,000.
Well, I can tell you the yield.
So there better be something else to help you out, or you're going to have a serious reduction in your lifestyle, David,
Here's the
right?
problem. The dividend yield in the S&P 500 is 1.5, about 5% right now.
It is?
Yeah, 1.5. And the average bond yield inside of a 60-40 portfolio is probably about 1.8 right now, which has gone up. So your blended yield is less than 2%. I mean, it's in like 1.6, 1.7% range. Think about that for a minute. So that's the cash flow, right? And we're in the cash flow business. So our average client has cash flow around 5%.
Right.
So just on its face, if the cash flow, and I go through this with clients on our big giant whiteboard we have, here's the portfolio, here's the income that's being produced. Again, I use real estate as an example. I'm not selling the real estate. I don't want to sell the third bedroom of the real estate of the house. I want to use the cash flow, the rental income. So if you're living off the rental income of your 60-40 portfolio, you're getting less than 2% income, right? So we need around 5% to have a high quality of life, to be able to do what you want to do after taxes, inflation, those types of things.
I love when you talk about the two because it's 5% and it's maintaining your principal, right? Because your principal is generating the revenue.
We do the best we can, and we like to use dividend-paying stocks. We have we'll call this an enhanced dividend strategy. We won't get into today, but using cash flow from the stocks that we own. Again, we have a saying that if we're going to own stocks, we want to get paid, right? Again, like the real estate analogy. So we're going to use dividend-paying stocks. We're going to use real estate as an asset class. We're going to live off the cash flow of physical real estate that we own. We really like pharmacy, grocery. We've been involved in for a long time. Kroger, CVS, Walgreens. Our clients have. We've been investing in that type of space for almost over over a decade now, since 2011. Been great, in that range, getting 5 and 6% distribution rates. Again, we're not spending down the capital, right? So the only thing we'll do to do that is if we want to use some type of principal protected guaranteed lifetime income products, and that you'll spend that down, but that's okay. We're going to do that on purpose then.
Right.
We know we're going to spend that down, but the fact is the other assets continue to grow. Right, so
Gotcha.
we will use those type of products when it's necessary, but we're not going to start there unless that's required.
All right, David, hey, thanks so much. San Diego, if you want a second opinion done, and by the way, that's complimentary from David himself, his eyes looking at your portfolio for a complimentary second opinion. Hey, pick up that phone right now, 866-REYES-PLAN. Visit us on our website at reyesplan.com. We look forward to seeing you soon. Don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Hi, and welcome to this week's Retirement True or False. David, I have some great questions this week. Let me begin with, the best strategy in retirement is buy and hold, true or false?
That would be false. That'd be false. Yeah, false. Because, when you're accumulating assets, fine, market goes up, market goes down. But, when you go to retire, the fact is we want to make sure we protect capital. A lot of times you just can't wait for that buy and hold and that dip to be 20, 30, 40, 50%. So no, we want to protect capital at all times.
And it also seems to me, David, that this is an antiquated, the 80s and 90s, the amazing bull run. You know what? You could take a dart, throw it up on the wall with a set of stocks. And I remember I was a kid, but there was a monkey that would do it and compete against the stock market, and the monkey would sometimes win. We no longer live in that environment, right? We have low interest rates. You have to have an advisor with some smarts today to get you a reasonable return on investment and protect your assets. True or false?
True.
Yes, absolutely.
Yep.
Okay, my next question to you is, because we are in a historically low interest rate environment, retirees must take more risk with their nest egg in order to achieve their retirement goals. True or false?
False. Interesting article I just read on the way in here today. It's funny. They're about pension funds, right? And they're trying to change legislation with this particular state to increase the risk because bonds and stocks both fell in the first quarter. I think stocks were down 4% and bonds were down 5%. And he goes, we just want to invest something that can actually go up. So part of their solution, they're trying to petition the board to be able to increase the amount of hedge funds and private equity they put in.
Wow.
So look at what happens to the institutions. They're trying to get more aggressive to get returns, and same with the public. And that's what they're told by the advisors sometimes, but wrong advice.
I got to tell you, that kind of scares me a little bit.
Absolutely.
Because the board is making this decision for all of these wonderful people that have worked their whole lives for that company. Now they're going to take more risk. Ugh. Yep. All right, last question of the day. Are you ready, my friend? It is important to reduce the fees on your investments as part of your retirement plan. True or false?
I don't know. Let's see which one we got here. True. Yes, true. True. Yes. True. Absolutely. Yeah. Fees are one of the biggest things we look at when we do our reviews or our second opinion reviews is fees. And most clients are paying 2 to 3 times more than they think they are. So they're a big destroyer of capital, especially when markets are going down. It's like insult to injury, like we're dealing with right now. For sure.
Because they have to make up the fees, right? And hey, listen, they're still getting paid whether it went up or went down, right? And I remember this one great example, $500,000 investment, 3% fees on it, which is $15,000.
Yep.
Over 10 years, David, that's $150,000 of fees on a $500,000 investment. In what world does that make cents.
Yep.
So the gist of the balance of this chapter in this book that I read said a 1% reduction in your fees could potentially add 10 years to your retirement. So just to kind of underline that importance of, hey, if I can in fact get my fees down by visiting an advisor, why in the world would I not look into that?
Yep, absolutely true. Yeah, we deal with that every day. Reduce fees, reduce risk. Yes, absolutely.
Hey, listen, one last question here
Yep.
before we go. You said it earlier that most people don't understand their fee structure. How often do you see someone who thinks they might be paying like 1% or 1.5%, and then you do a deep dive and find, well, it could be a lot more than that?
All the time. I had a client just the other day that had their advisor charge them no fees, right? So I don't pay any fees. And they had all these high loaded mutual funds, and their fees on their mutual funds were almost 3%. But they didn't think they were paying any fees.
But you get that big thick book that comes in the mail, right? And doesn't everyone read that cover to cover?
Absolutely. Absolutely
So
not.
I actually keep it on my nightstand, David,
Yes.
because if I can't go to sleep, I'm usually asleep by page 6.
Yep.
Hey, David, thanks so much. If you want more information today, even better, if you'd like to have a complimentary consultation, give us a call in the office, 866-REYES-PLAN, or go to our website, reyesplan.com. And don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
Now more than ever, it's vitally important to review your current retirement plan and get an educated second opinion. Hi, I'm David Reyes, and for many retirees and pre-retirees, this is a very confusing time. As a family-owned business right here in San Diego, we have educated hundreds of families on how to retire with confidence in all market conditions. So let us help you. Give us a call at 866-REYES-PLAN for a complimentary second opinion. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
This week we're going to talk about market risk. Before I get into that, let me share a story with you. Just a couple of years ago during COVID, I don't know if you remember, but COVID, the market dropped 35% in 30 days, really less than that. It was the fastest drop in the market in the history of the market, including the Great Depression, 2008, the 2000 tech wreck. I had a client come down and sit down. We were doing a stress test on his portfolio. 70 years old, a couple $1 million in the bank, looked at his investments. He was about 70% stock and about 30% bond. Like, okay, he's moderately, he's not conservative, but he's moderately aggressive. Bottom line, I looked at his portfolio. He had lost 50% and he was 30% bonds in a month. And I looked at his portfolio and look what he owned. He owned all the cruise lines and he owned all the airlines right in the middle of COVID. So my point being with that is two things. A, we got to know our market risk, and B, we got to know what we own, right? So when we do our stress test for clients, we go through that, but don't be that person, especially today. We're going through different market risks right now, right? We're going through, went through COVID, now with the COVID crash, and now we have issues like Ukraine, inflation, things like that. Federal Reserve raising interest rates. So market risks are high right now. So one of the things you want to make sure is, are you taking the appropriate amount of risk? Most of us are taking on more risk than we think. So just going back in markets, you can look at this kind of lost decade between 2000 and 2017. The market basically almost went nowhere. The market dropped in 2000 to 2002, the market dropped 50%. From 2007 to 2009, 55%. Again, COVID down 35%. This year we've had a lot of market volatility, historic volatility. And the reality is when we enter these kind of zones, it's different here if you're 50 years old or 45 years old and got another 10 years left. But most of my clients are in their early 60s, mid 60s, they're about to retire, retired. The difference is if we start taking income during these markets, it's going to be a problem. That's how you run out of money. So the reality is we want to make sure that your portfolio makes changes as the market changes. And really it's not so much about the market, it's more about what the results are that you need going from accumulation to distribution. Again, working years versus retirement years. So one of the things you want to do is evaluate your risk and make sure we don't have the potential for these large drawdowns of 50% plus, 30, 40, 50. We want to talk about 5 to 10% losses is much more appropriate in retirement. And again, one of the things that's a result of this is making sure you're working with a retirement income planner. A big difference when you're accumulating assets, you can have those growth assets, you can have that pretty pie chart. Once you get into retirement or near retirement, that retirement is at red zone of let's say 5 years out, we want to make sure that we have a portfolio that's going to be able to deal with market volatility. If you have any questions about the topics today or anything I've talked about, please reach out to us, give us a call, or go to our website.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have, by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no obligation, full-blown financial review today.
Are you unleashing the possibilities of your assets in retirement? Hi, I'm David Reyes with Reyes Financial Architecture. As a retirement and investment advisory firm here in San Diego, we've helped countless retirees and pre-retirees create a cohesive plan to maximize their assets and, most importantly, their cash flow in retirement. Call 866-REYES-PLAN right now to schedule a complimentary second opinion review. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Thanks so much for watching this week's show.
And if you want more information about anything we spoke about here today, give us a call in the office or go to our website.
And remember, you retire once, we retire every day.